So ladies and gentlemen, this stock has sparked up my interest. I want you to take a guess at what stock I'm talking about. We're going to talk about a very under the radar, boring stock. People are just looking over this one. I tend to think this one's a little bit interesting, a little undervalued. Oh, and did I mention it pays over an 8% dividend? Yeah, let's get into it. Now, we've talked about a barbell approach on this channel. Having your safe, boring treasuries, fixed income, high quality dividend stocks on one side, and then maybe your growth, higher risk, higher valuation type stocks on the other side to offset the beta and having balance in your portfolio. Now, this is a different approach to barbelling. I got healthcare on one side. As most of you know, I think healthcare is undervalued. Companies like CVS and Pfizer come to mind. And this other side of the barbell approach, while we got healthcare, what do you think the other side should be? If you were thinking about wine, beer, and spirits, you're on the right track. I'm talking about British American Tobacco. Over the last 5 years, this stock has pretty much traded sideways, going from $31 a share basically to $45 a share. In the trailing 12 month, the company is trading at a single digit PE, and the forward PE on it is sitting just above 7.5. Currently, the stock is paying over an 8% dividend. And this one is getting interesting, guys, because I tend to think that right around this price target is where the stock actually is pretty interesting, both from stock appreciation, but the fact that there is some growth being shown in this company, going from 14.1 billion British pounds all the way up to 27.6 billion in British pounds. Here's where this is interesting. It's not only the top line revenue growth and the nice spike that we recently have seen in the stock. As we could see, basically through 2020 and 2021, pretty much stagnant growth, but check out 2022 here, had a nice pop. What makes this company so interesting is going to be the margins in this business, over 40% EBITDA margins, and that comes through on free cash flow pretty nice, with pretty strong free cash flow margins pushing once again in the 40s. Now, you're going to deal with political tension with companies like this sometimes. You know, obviously, no smoking is a health hazard, and there's definitely going to be crackdowns and things that depress the prices. When we're looking at the actual business model as a whole here, we can see that margins are very strong. From a valuation standpoint, the company is trading well below its peers. From a price to cash flow standpoint, trading at roughly 5 times price to free cash flow. The industry standard is trading 3 times that amount. It's making this one look really cheap. Obviously, that 8% dividend yield also is nice to see. And normally when you see these high dividends, you normally don't get a good safety rating on it. And this one is getting out this one's paying out roughly 49 to 50%. Pretty solid B- grade. So now the question becomes, at what price point is the risk versus reward worth a drag of BTI? Now, if we look at top line revenue growth going from 14.1, so we're going to get a quick idea what analyst expectations are for the company. And I've already started converting British pounds into dollars to get a good estimate of what we should be paying for the stock. The interesting thing about this stock is Yahoo Finance has double-digit revenue growth on this stock. And if that's the case, then this is extremely cheap. We have a very strong buy rating on Yahoo as well. But when we go to stock analysis and do a forecast, doesn't look like there's many people covering this one in stock analysis, but we're getting single digit growth on this one. So pretty contrasting opinions when we look at what the expectation from analysts are here. And so I'm going to use single digit revenue growth just to err on caution and get an idea of what we should be paying for this stock. So using 4%, 3%, and 2% growth rates, looking for a 12% compounded rate of return here. So when we're looking at a multiple to put on this stock, you can see here that EV to EBITDA in the trailing 12 month is sitting around 8, while the industry standard's at 13.4. So it's definitely, so we can see here, it's definitely depressed compared to its peers, which could lend a buying opportunity. I'm looking at margins, I'm looking at revenue growth. Everything looks good with this company. The one knock I would say is I wish it had a little bit less debt, but they can absolutely handle the debt here. From a free cash flow standpoint, guys, take a look at this. $48 a share. This company does print out pretty strong free cash flow. From an EV to EBITDA, we're getting basically between $26 to $30 a share. We average that out. You know, I could see buying the stock anywhere between $25 to $35 pretty comfortably here. And basically, you can buy as many shares as you want with an 8% yield at $33.05. So I think there's some upside here where you have, obviously you have a great dividend, but there looks to be some opportunity for capital appreciation and revenue growth here with a very strong margin business and a business that prints out a pretty significant amount of free cash flow compared to its revenue. So this one's a pretty interesting one to keep an eye on, guys. BTI, let me know what your thoughts are, and we will see you in the next one. Peace.